Hello and welcome to Savills webinar. Today we're going to be focused on residential research. Over the past few weeks we've had a multitude of questions about what's going on and what's happening in the London market. So we feel it's appropriate to request the presence of Katy Warrick, who is our head of London research. Katy's been with Savills since 2011 and specialises in both second-hand homes and new build. After the presentation, I'll show you a couple of schemes that I think are pretty special and ones to look out for at the end. And throughout the presentation, there'll be the option to ask any questions you may want to ask. Myself and Katy will be able to answer those after the presentation. With that, over to Katy.
Hi, I'm Katy Warrick and I head up the London residential research team here at Savills. And I'm going to talk to you today about what's going on in the residential markets in London. Here from my living room in Shepherd's Bush, because the UK is still in lockdown. But what I'm going to talk about is really focusing on how the market has fared over the course of the last year in light of COVID. And it's actually surprised us all, so I think you'll find it quite interesting. I hope you find it useful. Thank you. So I'm going to start with a bit of a review of 2020, which was definitely not as we expected when it comes to the housing market. So firstly is the fact that we saw the first modern day recession where the economy and the housing market moved in different directions. Low house price growth in the lead up to this pandemic, coupled with low interest rates, means that it really was marked out as very different to previous recessions. Government intervention on jobs, earnings and stamp duty provided a safety net. And that resulted in a market that is very much driven by those with financial security rather than those who are exposed to the financial and the economic fallout. And it's those people who really have been reassessing the housing needs and their priorities, and that's essentially overridden the economics of it all. And that's left us with really strong house price growth. So at a UK level, 7.3% growth at the end of 2020, which is the highest it's seen in 6 years. And for London, that figure is 6.2%, also really, really high, and much higher than we were expecting. The same for transactions, are running much higher than we would have expected, 13% above previous year, and mortgage approvals up 58% as well. And on the rental side, it's a bit of a mixed picture, with the residential rents falling in some city centres, including London, and I'll talk a little bit more about that. So the boom in market activity has been driven by behavioural changes which are brought on by the experience of living in lockdown. We conducted a series of surveys over the past 12 months, and consistently respondents have stated that they are more likely to work from home more frequently in the future. And what that means, of course, for the residential market is that they'll be looking for different things from their home. We've seen a shift in demand for larger properties with more space inside, but importantly, it's more green space outside and crucially with great digital connectivity. And admittedly, not everyone has space for a shed at the end of their garden in which to work from home, but making sure the layout of their homes allows for two people to work from home at the same time is now becoming an important feature. So here you can see that actually, we surveyed our tenants and 71% of them are more inclined to work from home in the future. And that increases in the media and information and tech sectors, and also finance and insurance sectors. But despite this increased desire to work from home, tenants also ranked being in close proximity to a tube or train as the most important factor when looking for their next rental property. So that hasn't changed. That has always been the most important thing. But also number two is proximity to a park or open space. So now let's focus in on London. Why does London have such a great appeal? We know that it sees significant amounts of investment, and there are a number of fundamental reasons why people continue to invest in London property. And these reasons haven't been impacted by COVID significantly or Brexit. The culture, history, time zone, nightlife and education. Even though things are a bit different at the moment with COVID, it won't be like this forever, and London will remain a highly prominent global city. And despite Brexit and COVID, London remains second in the rankings of 111 major financial centres around the world, according to the Global Financial Centres Index. And this was done in September 2020. And of course, since that point, we've now left the EU, and the financial services sector was not part of that latest trade deal. However, Oxford Economics, a well-regarded economic forecaster who we rely on heavily for their view, inputs into our forecasts, they believe that London's dominance of Europe's financial services is not hugely threatened by this. And in fact, they're stating that in 2019, London's financial jobs still dominated, and it was equal to Amsterdam, Dublin, Frankfurt, and Paris combined. So with all of that in mind, it's really no surprise when we look at the volumes of investment globally that London ranks the top city, seeing just a 3% fall on 2019 levels of investment. So let me now move on to talking about the different segments of the market, and I'll start with the London mainstream market before moving on to prime. 2020 saw London's highest annual house price growth since 2016. There have been a number of different factors driving this despite the ongoing pandemic. The stamp duty holiday has provided an incentive for buyers to move, and that combined with the release of pent-up demand following the reopening of the housing market following the first lockdown. The new build mainstream market, so what we define as mainstream is below £1,000 a square foot, this market saw a 12% increase in the level of exchanges of new build properties in 2020 compared to 2019, which is remarkable. London's rental market has been hit by the effects of COVID-19 pandemic, and supply has been increasing due to an increase in the level of Airbnb properties which have switched onto the rental market, and corporate and overseas student demand has dropped off following the disruption and restrictions to international travel. But the good news is this is temporary. The vaccination rollout will improve mobility and sentiment in the market. Supply will constrain growth this year, but when international travel opens back up, the corporate relocations and students will return, and also some of that supply, when tourism returns, some of that rental stock will revert back to Airbnb. Rental growth will remain dependent on the economic fundamentals, the strength of the jobs market, and crucially income growth. And actually London is we expect London to lead the way with stronger income growth than the rest of the country. We haven't yet published the figures, but our provisional forecasts for London rents are looking close to 20% over the next 5 years. And I'll just quickly touch on those economic forecasts because they really provide the fundamentals for our view on the timing of this housing market recovery. And I think it's helpful to look at how these have changed over the year and the impact that a third lockdown might have. The forecast for both GDP and unemployment have shifted, and here we're looking at the Oxford Economics forecasts. They're pretty sort of central, middle of the road forecasters that we tend to use to inform our view. And they've noticed that as the situation has progressed, the restrictions have progressed, the forecasts for unemployment and GDP have moved too. And as the furlough scheme, our jobs protection scheme, has been extended, the spike in unemployment has been pushed out, and it's now likely to be around 7% as that furlough ends in March and April. And at the moment, it's quite hard for us to know whether it will be extended again, but there might be some more stimulus in the budget at the beginning of March. So whilst these forecasts have gotten worse, the forecast for the base rate has actually improved. So Oxford Economics expects that the base rate will stay low for much longer, staying at 0.1% until mid-2024. And that's really crucial for our forecasts for London mainstream market, because that will ease some of the affordability pressures and open it up for greater price growth in that medium term. So what are our forecasts for house price growth? This year it's going to be complicated. We think it'll break down into three main parts. So the first quarter of the year is likely to see some continuation of the strong growth and activity that we've seen so far, as buyers look to beat that stamp duty holiday deadline at the end of March. And now that we have a Brexit deal, I think that will provide some comfort to some people. The latest lockdown will constrain things a little bit further. However, the last lockdown in November, it had actually quite little effect on the housing market. But there's early evidence that this current one is dampening the market a bit more. It is a bit more strict. We also have the last days of the current Help to Buy scheme before that changes and becomes more restrictive at the end of March. And what that means is basically it means that it will be limited to only first-time buyers. And that's less of an issue in London than it is in other parts of the country, because actually it's 95% first-time buyers who take this product up in London anyway. The next phase, the middle of the year, is likely to see much weaker activity as the boost from the stamp duty holiday is lost, and the economic realities, peaking unemployment, are likely to also constrain the market. We'll also see the reduction in home working, which may bring some demand back into the city centres. And then in the later half of the year, we're likely to see a return to more fundamental economics. We'll hopefully have the vaccine rolled out further. It will allow us to return mostly to normal life, and we'll be seeing that unemployment peak coming down. And on the other hand, we have that realistic prospect of tax rises, which may act as a drag on value growth. We'll start transitioning to a new work-life equilibrium. And thereafter, the shape of that growth really mirrors the economic recovery, and we expect a bounce back in 2023. Now I'll move on to the prime markets. And just as a reminder, by prime, I'm looking at the top 5 to 10% of the market by value. So in the lead up to the COVID outbreak, we'd seen weakness in prime London, particularly in central London, since 2014, with stamp duty changes and Brexit uncertainty, which really dragged on buyer confidence. And then we had the general election in December, and that result really did give a bit more certainty. It lowered the risk of a hard left government and a clearer outcome for Brexit. And as a result, we saw that Boris bounce in transactions at the end of 2019, early into last year. And then from that point onwards, we'd really seen quite a lot of price falls previous to that. So prime central London was sitting at about 20% lower than its peak in 2014. And that suggested that the market was really overdue a recovery. And we were just starting to see that materialise when, of course, COVID. And the initial reaction to COVID, with a closed market, it was more uncertainty, and it resulted in price falls again by 1% across all of prime London, and a bit higher, a bit sort of deeper falls in across prime central London, minus 2.2%. But actually, once the market reopened, some of that uncertainty eased, and strong demand in some of the markets meant that actually, those price falls have stabilised. And it varies quite a lot across the different London regions. I've got this chart on the right-hand side here, which shows those different regions. Generally, the markets throughout the southwest and the west, such as Wandsworth, Richmond, Chiswick, they've been much stronger performers as lockdown has driven. It's just picking up on some of those behavioural changes. People looking for more space, the size of their home, and also placing a higher priority on green space or open space. Whereas markets in such as prime central London and the northwest, which is St John's Wood and Hampstead, they've been slightly weaker. They're much higher value. They've also seen the much greater price falls since the peak in 2014. And of course, that's only half the picture. The other half we need to look at is how many transactions there are in the market. So here we're looking at the level of sales over 1 million across Westminster and Kensington and Chelsea, those two central boroughs. And you can see where transactions fell first in that first lockdown in April 2019, and the steady increase that we've seen from then. So now we are at what we would consider back to normal levels. In December, we were at a similar peak to the one we've seen in December 2019, when the market was experiencing that Boris bounce I was just talking about. And this is particularly remarkable considering how dependent prime London is on international buyers, and the fact that London at this point has been shut to those buyers. So we're looking at the traffic of passengers coming through Heathrow, it's really very low. So we see that there are definitely still plenty of opportunities for international buyers, and one of the main driving factors is the currency play on offer. And of course, this is very apparent for the market above 5 million, where they've seen greater price falls in this market, but even for the market at 1 million. And considering those price falls we've seen and the weakness of sterling, those buying a £1 million property in euros are paying almost 24% less today than they would have done before the EU referendum. And those in US dollars are paying 19% less. So whilst London has been significantly impacted by stamp duty, when you look at the comparative costs of buying, holding and selling a $2 million property as an overseas investor, you're actually paying significantly less in London than you would in other cities such as Hong Kong, Singapore and New York. And even with the additional 2% stamp duty that's due to come in April, that doesn't dramatically change. So we're anticipating in the run-up to that you might see a few more international buyers rushing through sales in the first quarter. It's not going to be a significant amount. So bearing all that in mind, what do we think will happen to both capital values and rental values across Prime London? I'm pleased to say that our 2020 forecasts were almost bang on, although we did see a slightly greater fall in rental market than we anticipated. We do expect to see a bounce in capital values this year and going on into 2022 as that international demand comes back. And particularly in central London, which has been so weak for 6 years already, and values have fallen by around 20%. There are so many buyers that are sitting on their hands. So that recovery that we had started to see, those early signs of at the beginning of last year, we expect that to come once in sort of greater quantities, once people have a bit more confidence in both the market and the economy. Though by 2024, towards the back end of that period, we are likely to see another general election, which we know does increase caution, especially for that more discretionary prime market. And then for the rental market, as we've already seen so far, values have been more impacted this year, and it may take a little bit more time for that excess stock to work its way through the market. And it's very dependent on how quickly a widely rolled out vaccine will see demand return from tourists, corporates, and students. So I thought I'd just leave you with a couple of thoughts from me. I'm often asked what my top pick would be. And I have to say at the moment, and this is assuming I would have the budget, Prime Central London is looking like quite a good buy. And there, our forecasts are 17.5% over the next 5 years. And there's definitely some pockets within this region that I'm favouring more than others. I'd veer towards the sort of the lesser known or less traditional areas within Prime Central London. I'd go for Earls Court or Bayswater. They're both very central geographically still. They're next door to higher value, well-established residential areas, and they're both seeing significant investment through new development. I think it could be quite interesting to invest there at the moment. And then a couple more trends. The 15-minute city is being talked about a lot at the moment, and I think that this is very relevant. People are living a lot more locally at the moment, so any schemes which are mixed use, close to high quality amenities and shops, they should perform well. People are going to be looking for these sort of things. And don't forget the transport connectivity. So our tenant survey showed that despite people working from home more frequently, it's still going to be very important for tenants to be living close to a tube or train station. And then finally, the importance of open space and the social space where people can exercise and connect with other people. I think never before has this been so important.
So that's all from me. Thank you for listening, and I hope you enjoy the rest of the webinar. Thank you.
Okay, as promised before the presentation, there's a couple of schemes that I personally am looking out for this year, along with some of my clients. First and foremost is Hackney Wick, which is the development by Galliard Homes, part of the larger Stratford regeneration, but also part of the very domestically popular Hackney regeneration. Certainly want to have a look out for. It's launching next month in Hong Kong and in the UK. Aside from that, we've got a fabulous scheme coming in Bayswater, right next to Hyde Park, and part of a wider regeneration of the area. So a very prime part of London, but that is in need of a bit of maintenance and regeneration. Finally, Embassy Gardens. What we think is one of the best regenerations to ever grace London is part of the Nine Elms regeneration, but in particular Embassy Gardens, which surrounds the Norman Foster US Embassy and is next to the new Nine Elms underground station. For more information on any of the presentation or the schemes that I mentioned, please reach out to myself or any of the experienced team in Hong Kong.